So flow of events, guys, is going to be, I'm going to set the stage. I'm going to make the introductions. We're going to go into sort of the minutia in terms of how do you raise funds, what are the panelists seeing, and then we're going to take it back and look at what's happening in the market. My name's Amanda Galton. I'm a partner here at San Francisco office. 95% of my practice is on working with companies, some of you in the audience I get the pleasure of working with. 5% is working with investors. I work with people who are in their garage, who don't even have a garage. I work with companies that are growing Series A, Series B, companies that are looking at IPOs and exits. So I really get the pleasure of working with great entrepreneurs who are going through, and Bill and I were talking about this, it is hot right now in terms of fundraising. How do you raise money? Who's raising money? And these issues are topical, timely, and I know they are challenging. So it's great to have such an amazing panel. I'm just going to go down the row here and I'll let you guys introduce yourself, introduce sort of what fund you're working with, and also just a snapshot of sort of something that makes you a little bit different, unique than the classic VC cookie cutter idea of a VC. How about that?
I'm on a board with you, so that makes
There we go. I get that's you get the pleasure of that.
First round of applause for you and Orrick. I think great event. So thank you guys. It's great. Yeah. So Bill Malloy, one of the general partners at Sway Ventures. We our tagline is we're created by founders for founders, and we just know how hard it is to create venture-backed companies. So we're based here in San Francisco. We invest in early to medium growth companies. And for us, it's all about teams. I mean, teams solving really hard technical problems is really what gets us excited. What makes us different is we really focus on driving revenue and unique sources of capital. Yes, there is a lot of financing going on. So we try to roll up our sleeves and really be helpful where we can.
Excellent. Sarah?
Sure. Hi, I'm Sara Thomas. I got married recently. I keep using the old last name. So I'm Sara Deshpande now. It's longer and harder to say, but maybe a little bit more unique.
Cool,
so I always slip into the old Sara. I'm a partner at Maven Ventures. We're a seed fund focused primarily on consumer software. We're also looking at new areas of consumer innovation. We've been very active investors in autonomous vehicles, for instance, and a few other consumer trend areas that we're looking at right now, which happy to expand on a little bit later. We tend to lead, co-lead, and participate in seed rounds, so usually $250,000 to $500,000 checks.
Excellent. Garrett?
Garrett Goldberg with B Partners. We're an enterprise version of Sara's fund at Maven. We're first check writers, actually. We are first investors in over half our companies, so tends to be a little bit unique there. Oftentimes pre-product, oftentimes the day that the company was formed. So a little bit unique in that regard. We talk about frontier technologies. We like to talk to founders that are operating out or beyond the frontier tomorrow's solutions. So thanks for having us.
Hi.
Hi, I'm Kathryn Boyle. I'm an investor with General Catalyst. We are a sector and stage agnostic fund, though our sweet spot is Series A. And we're investing out of our 8th fund. We were started in 2000 in Cambridge, Massachusetts. I'd say what makes our fund very unique is that we have 4 offices, probably the most real estate of any fund in San Francisco. We have Cambridge, New York, Palo Alto, and San Francisco. And what makes me a little unique is that before I was a venture investor, I was a reporter at the Washington Post. So definitely a very different path to venture, but I always joke that it's the same job. So.
Chris Gottschalk, Blumberg Capital. Blumberg Capital, classic early stage venture firm. We look to lead seed and Series A investments, so writing checks $500K to $5 million, really up and down the tech stack, so everything from storage, infrastructure, cybersecurity, all the way to consumer facing. And then unique with Blumberg, a relatively broad geographic mandate, so investing North America, Europe, and Israel with an office in San Francisco, New York, and Tel Aviv.
Excellent. So just for the panelists' sake, can we get a show of hands in terms of how many of you in the audience are in active fundraising, need to raise funds? Oh, great. And in terms of how many are sort of in the, I'd say, 0 to 500,000, the smaller sort of raises? And then how many are in the 500,000 to, let's say, 1.5? And then how many in sort of the 1.5 and beyond? Great. Excellent. So I'm just going to launch in. As I said, I was thinking about this panel and thinking about what's interesting to entrepreneurs and what's interesting to companies. before we go big, what are we seeing in the market? What are the numbers? I'd like to go small and sort of focused on what does it take to fundraise? What do our panelists look at when they're looking at fundraising? What are some of the red flags? What are some of the green flags that they're looking at? And so I guess, Bill, since you're both nearest and also I've seen you in action, what's getting funded? And then on the flip side, what's not getting funded?
So the first one on what's getting funded is half joking, half serious, but anything with AI in it, I feel like is getting funded right now, almost to a scary point. The number of decks that have come across, our desk that it's like a gene company, like literally making blue genes. It was an artificial intelligence blue gene company, and I'm like, I don't understand how it's possible. So I feel like in machine learning, I think there are a lot of legitimate engineers that have really strong technical talent. I do think a lot of money is starting to chase AI that may be chasing something that's not necessarily there yet. That's one thing that I think is, it's a fact, but it's also a little scary. I think commerce in general went through a big boom, and I still think there are a lot of great investors that are investing in commerce. I think the pool of venture capitalists that are directly focused on commerce is kind of taken a little bit of a condensed manner.
Interesting. And Sara, I guess I ask is, why should the people in the audience either care about sort of what Bill sort of laid out, or not care and say, I've heard about it, I don't have any AI, but I'm going for it?
Well, we look for kind of two primary things at Maven, and it's related. The first is the vision, the second is the team. And so we're always looking kind of what's that vision worth fighting for? Like, why does this thing need to exist in the world? You're going to spend a lot of your time and energy, and a lot of my time and energy, and a lot of other people's money on building this company. So what is that vision that you're bringing to the world? And I think for consumers in particular, how are people solving that today, and why are they going to adopt this new solution of what you're doing? And so I think as part of that, you kind of have to be authentic to who you are. If you have a way to really kind of branch into those hot areas that feels natural, that's actually part of your business, I think that makes sense. But you have to be kind of authentic to who the business is. Another area that's really hot right now, we've been really active investors, is autonomous vehicle technology. We've funded, I think in total, 4 companies in the autonomous space, 5 companies total in transportation. And so now the number of companies that come to me, they're like, oh, I'm an autonomous vehicle company. There's a ton of stuff, and we love meeting them, and we continue to fund them. But as we dig a little deeper, we'll find out you're actually not an autonomous vehicle company. You're like some type of new transportation company that hopefully in 3 years can build autonomous vehicle technology. So if the kind of hot area fits your company, that's great, but there's a ton of other stuff that gets funded that's not kind of in that AI autonomous vehicle stuff. So if it doesn't feel authentic, I think you got to just leave it off the side.
And Chris, is there an area that you at Blumberg Capital are focused on that isn't in a hot space, that is in an area that is either up and coming in your estimation, or something that really interests you?
So we're pretty founder-led. I mean, we have themes and we go deep. We've gone deep in fintech and cybersecurity, and prior to that, ad tech and a few other verticals. But we're also founder-led in that we want to be shown new opportunities and ideas and taught new sectors. For instance, we did a deal in synthetic biology, and we're looking quite closely at the intersection of IT and healthcare, as many funds are. But that's new for us. It's something that we haven't done historically. And then lastly, I'd just say, in terms of fundraising, it's never easy. It's always a grind for entrepreneurs, but there's also never been a better time in history to raise venture capital. If you just look at the amount of dry powder that GPs are sitting on, you look at the velocity of deals, the number of dollars put to work, and also dollars raised outside of core regions like Silicon Valley, and you couldn't ask for a better fundraising environment, although it's still difficult.
Actually, this is a perfect segue, even though I was going to initially go big later. I mean, I think, Kathryn, we were talking a little bit about the macro cycle, and sort of in terms of building on what Chris said, I mean, where are we in the macro tech cycle, and building on your sort of DC, Washington Post journalism, I mean, where do you see us in this cycle?
Yeah, no, I very much agree with that. I think we're definitely at the end of a tech cycle, and there's a really great piece by Elad Gil, who's one of our founders. He's the founder and president of Color, called The End of Cycles, and what kind of happens to venture capital and to investors when you get to the point where people don't know what the next platform is going to be, and that is that they invest in everything. It's sort of like throwing spaghetti at a wall. People start developing theses and investing in things that they don't traditionally know that much about or have a lot of experience in. So I actually think it's a really great time to be more in an experimental space, something like synthetic biology, because 5 years ago, everyone was investing in mobile and in apps and in consumer apps specifically. And so I think it's a really interesting time if you have a more deep tech focus or are in something that's more frontier, that you probably have a better chance now than you did a few years ago.
Excellent. I'm going to circle back to something that Sara said and ask you, Garrett, in terms of mission, in terms of the core values of the company. I mean, how much does that, in terms of when the team here is looking and presenting to venture capitalists, how much should they be presenting their mission, presenting their core values versus customer acquisition costs and other business terms that may be driving your investment decision?
It's interesting. We have a saying that culture is the glue between your business and your customers, and so inherently your values are going to show in the product you build and the way you treat your customers. And so, yes, you have to explain to us what's the problem, what's the solution that we're building, why is now the time, why is this technology specific to it, but at the same time, that especially at the early stage when we're talking about a couple of founders, small teams, those values mean a lot. It's not something we specifically ask, hey, lay out your values. It's something that's going to come through in the qualitative assessment of an early team. So it means a lot.
And Sara, would you agree with that, or in how you're looking at pitches and decks, and where does it actually come up? Does it come up, just even getting down to the details, does it come up in the deck, or does it come up, in the handshake and the eye contact, and what cues are you looking for?
We're not explicitly like social impact or social mission investors, so it's not necessarily that type of vision. We want to invest in companies that we're proud to bring to the world. I think it's more about kind of like an unrelenting passion that this new thing that's really novel, it doesn't exist today. Like tens of millions or hundreds of millions of consumers need to interact with it on a very frequent basis, and we're the only people that can bring that to the world. So I think it's some combination of like a massive grand vision and also like the passion for that. I think values are, even with two founders in your company, you have a culture and you have values. You probably just don't have it written on paper. So we do, every company that we invest in, we actually do encourage them to actually write it down on paper, because you have to kind of, and we've done it ourselves and it's on our website. So that is important to us. Not necessarily in the investment cycle that we expect people have done it before they meet with us. But as soon as we invest, we do have people go through an actual culture and values workshop where you talk through the things that are unique to your business. We think it's a great recruiting channel. We think it's a great retention channel for talent. And we think it helps kind of in service of accomplishing your vision.
And how many of you guys in the audience have written down your values or have given that some thought? And I guess first written down the values. So, all right, excellent. It's probably a worthwhile exercise. I mean, I know even at Orrick, we're constantly going through and making sure that our values remain constant and that people understand what they are and remain relevant. But Chris, I saw on your Twitter feed last night when I'm sort of looking through and looking at everybody's Twitter feeds, you had an interesting piece on there about what makes CEOs successful, and it's not only sort of the most bombastic and alpha of leaders, and it's something that makes it different. So in terms of when you're looking, can you just talk a little bit about that article? And also, I'd like to talk to a number of you about when you're looking at the teams coming through, and you talked about the importance of teams. What's some of the traits that you're looking for in terms of making that fundraising decision?
Yeah, so I think it's important to realize that it's not one size fits all, and Sara said it well with authenticity. And so we look for a lot of different things when someone walks in the door, but authenticity is one. And the article talked about more introvert versus extrovert as CEO and manager and leader. And I think it points out well that again, if you're looking at a Myers-Briggs, it's not that one score beats another, but it's how those scores come together, how people come together, how they form organizations. And we look for what I call endurance athletes as well. Being a CEO, being a founder is a long haul. And if you're not in it for the long haul, that it's just not a team that we want to back, because there are so many ways that startups can break apart and fail. And having an endurance athlete at the helm, not just a single person, but a team, really helps them achieve and ultimately capture value. We're also looking for unique insights. So teams, people that have unique insights, not necessarily experience in the domain, but have insights on the domain. So they know where the dead bodies are, they know where the opportunities are, and they can navigate that and teach the VCs as much as they can the market. So those are a few things.
Interesting. And then Bill, in terms of, I guess before we go to Bill, in terms of how you build teams and how you look at teams, how many in the audience are single entrepreneurs looking for other team members, and just start with that, in terms of don't have really a team around? Okay. I know from experience it is hard doing it yourself. And I guess to that, Bill, do you ever receive meetings that you take that are single entrepreneurs, or do you wait to see the team that gets built around them?
Yeah, no, it's a fair question. I mean, I think for us, like, the number one thing is teams. The number two thing we look for is how hard is this technology to solve? Like, how many people, in this room or in the Bay Area or on the planet can actually solve this problem? Is kind of that idea of deep technology. But from a team standpoint, we'll take meetings, as early as we can. So single person founders. I was actually walking around the block on the phone with a single person founder. The reason I took that call was he just sold a company that was voice machine learning, wanted to do it again, knew he needed to get a co-founder or multiple co-founders, and was just asking for advice. So I think from our standpoint, we want to be helpful. We want to be helpful early on. And I think just to build on some of what the panel's saying about what are we looking for when it comes to great teams, it's not that you have to have built a company and had a successful exit directly with that specific domain expertise, but I think having some sort of unique insight, whether that's you were just a brilliant student and you had some insight on a technology and decided to drop out, or you worked at Facebook in a business unit, or it was a relevant company, there's some sort of muscle memory there, which I think is a key point. And then I think that multiple founder side of it is you really have to be willing to ride the ebb and the flow as a team, and you need people, whether it's Myers-Briggs or whatever kind of personality tests you do, it could just be your personal gut. You need to surround yourself with people that have different strengths and different weaknesses, because running a business is really difficult. So I think that idea of an athlete, or at least having a team that you built for purpose-built and you didn't just go hire a replicate of yourself, is something that's really hard to do, but once you do it, I think proves a lot of benefit.
Interesting. And Kathryn, is there any teams aspects or personality aspects that you're particularly drawn to in looking at either companies or evaluating before you even do the meetings?
Yeah, no, definitely with founders. I always like to say look for kind of original but non-linear thinking. I think most smart people in the world, there's tons of smart people, and usually what smart people do is you read something or you hear something and you get really good at aggregating those sorts of thoughts. I think the best founders I've ever seen just have original thought after original thought. It's incredible. Like one of my favorite founders in our portfolio is Patrick Collison of Stripe, and his mind is unlike anything I've ever seen. It's just a continuation of just original thoughts that don't make any linear sense to me until he gets to the end, and then it's just incredible. And I think those are the sorts of people where when you meet them, in some ways it's less about the market or the problem they're working on and just more about what they can do with their mind. So I definitely look for that as a quality, though I think it's very rare.
That's excellent. So Garrett, let's talk about stage. Like what stage? A lot of times people in the room or other clients will go to VCs and the message they get back is, we love you, we love the team, you're just too early.
Too early. It's a great source of deal flow for us, so keep it coming.
So, but what is that, what does that mean? And of course, it's each company is different, but is there, should they not have taken that meeting? Is there too early end of story, or is that an opening for something else?
It's probably an opening. Look, I can't speak for the later stage investors, but as we've solidified ourselves or saw the opportunity to build a firm at the early stages, that was why, because there's a lot of bigger funds that need to deploy more money, and so writing a $250,000 check into these $700 million rounds just isn't plausible for them. But they do want optionality. They want to look at the deal when it comes back around, and so that's going to be the first phone call if that firm emerges and is a Series A potential. So, there's an opportunity there at that early stage. I know Maven does a lot of it too alongside of us. And so solve for fit when you look for your investors. It may be worth taking the meeting. Investors will take meetings, but we're super respectful about wasting founders' time. And so make sure that it's a two-way interview, that you, the founder, get something out of it as well. But solve for fit.
And so, Sara, I mean, you also are sort of looking at, because you are sometimes the first check, or is that sort of something that you're either known for or you sort of pride yourself on, or do you really wait to see what happens and credit cards get maxed out, family gets maxed out, and then your first check, or how do you sort of evaluate?
I get a great answer. It depends. So we are pre-Series A. So we want to come in, before you raise that kind of true Series A round. It can be first check, and we do that. Sometimes it's a seed extension when things have been proven out. I think blanket, it's too early is one of the most annoying, massive VC cop-outs out there. And the reason I think that is there's always sub-bullets underneath that. So we try, and I can't do it all the time because we meet so many, I literally look at 3,000 different companies a year, meet with hundreds and hundreds and hundreds of companies. So I wish we could spend more time giving thoughtful feedback. If I've taken an in-person meeting with somebody, I do try to give them some reason why we're not investing in the company. If the answer is no, it might be a lack of conviction. It might be, something around the market. It might be something about competition. It might just be that we don't share the belief that that's a massive vision. When we try to say that, if it's too early, there has to be a sub-bullet to that of and here's what I'm looking to have. Here's the risk I'm looking to have removed, because that's what too early means. It's right now, there's too much risk in this business for me. If you can prove this thing or these couple of things, then that would be a stage that I'm more comfortable investing. Most of the time, people just are scared or don't want to. We want people to like us, and I totally get that. I want people to like me too. But I'd rather try to be honest and forthcoming with those reasons of why we're not investing. I think most people don't, but I think it's a good practice to get into. So we can be really early if we have super high conviction, if we've known the team for a long time, if it's an area that we're passionate about, if it's an area that we're experts in, we know a lot about it, for sure we can do it. But some of our investments, we've actually said it's too early, and here's the two things it would take, and they've come back to us a year later, and we funded those companies. So it's something that we've done in practice.
Actually, that's an interesting, in terms of sort of going, how many of you on the panel, and we'll start with you, Chris, in terms of have said no, and the entrepreneur kept coming back, and you've said yes? I don't need specific numbers, but an approximation, 50% of the time that happens, or is it really rare occurrence?
It has happened. It's rare. In terms of our funnel, we see thousands of business plans per year. We probably meet, there's 6 investment professionals. We probably meet, anywhere from 750 to 1,000 companies. That's at least, one investment professional has met a company. And we're going to invest in 10 to 15 deals a year. So the funnel the conversion obviously is very low. So it has happened, but it's probably only happened, 3 to 5 times is my guess over the 15-year history of Blumberg Capital.
Bill, you
Yeah,
agree?
no, I'd completely agree. Just kind of thinking off the top of my head, I don't have the exact numbers, but yeah, I think it's not a high percentage. There have been some opportunities that we gave the thoughtful feedback. We love you, but if you could go and do these 3 things, that's what we're looking for. And they came back. It wasn't next week, but it was 12 to 18 months they've been able to prove it, and then we looked at that. And I think making a comment on the seed component, we're primarily Series A. That's really where we invest. But
I think the too early comment is different for Series A. You know what I mean? It's a different thing, because it's no, you actually really are too early for what we're doing, right?
But we do about 10 seed deals a year, and there's some seed deals that it's just you have to get into that deal because the founder or the market or whatever. So, Penrose, which we're on the board together. It was one of those opportunities. The founding team was amazing. It was in virtual reality. They just spun out of Oculus. And, after we financed it, as we were going through it, there were other companies basically doing follow-on rounds before we'd even close that round. So I think every VC, whether or not they say it or not, has the opportunity really, really, really to do seed rounds if they have conviction. So I think even someone like Founders Fund or Andreessen will write checks early stage for the right opportunities. I think it's all about, a lot of this is about partner fit, and I don't think enough founders spend enough time on that, whether it's seed or later stage. But I think really identifying with individual firms, but also individual partners to figure out what their conviction is specific for an investment thesis or a team.
But I'll just say quickly on the stats. I'm just running the numbers in my head, but out of the 28 investments we've done across 2 funds, I can think of a minimum of 4 off the top of my head that we've said, it's too early, here's why, and we've done that deal later, one of which was a really successful exit for us, one of which went out of business. So, but those are the stats. So I can think of 4 of 28, which to me is a pretty good number. Yeah. So at least when we say it, I try to mean it.
And Garrett, and what about you in terms of companies you've passed on and circled back on?
I swear to God, we have never written this deal is too early. In the history of B Partners, we have never written that. Sometimes it's a night.
And you don't have any other...
It's such an easy excuse, though.
I know, and we hear it all the time. And so look, sometimes it's an idea, it's not big, it's not a real business, they don't have the right team, but we have never ever written.
By the way, do you tell people that? If you're like, it's not a big enough idea, you don't have the right team, do you tell people?
Of course.
That's good. It's great feedback, because I mean, a lot of times the pleasantry comes out, or it's not really even pleasant, it's the reverse, but then it just lands there. So, and Kathryn, how about you in terms of passing and circling back?
Yeah, well, to that point, I can't speak for the entire history of the firm, but we do have a rule that we are not allowed to ever say or write, it's too early. And we also give what we hope is productive feedback and honest feedback on every deal that we see. So.
Excellent. And Bill, circling back to what you just said on partner fit, how does an entrepreneur do that? I mean, a lot of times we get entrepreneurs who ask us, and that's in terms of the part that Lauren plays, but how does, from someone who's either not working with Orrick or not working with a law firm, how do you look at partner fit? Do you go on the Twitter feed and see, okay, Chris, I'm an introvert, I'm going to go to Chris,
No, look, I mean, I think it's just good old-fashioned networking, however you want to do that. Yeah, I think, online is a great source, like you said, whether it's Twitter or Medium or whatever. I think venture capitalists have really now, more so than ever, embraced online media and writing. I think a part of that is, marketing, but it also starts to get that partner voice out there so people can identify. And then I think, the blind email on, hey, I saw your email on the website and I'm just going to send it to you, that doesn't have a lot of thought, really doesn't work. So I think trying to find some connectivity, another founder, or some just kind of that, what I mentioned, the good old-fashioned networking. Because if we're only doing 10% of our fund, I'm just making that up, into consumer deals, and hey, I noticed that you're all about consumer, well, I mean, instantly off the bat, it's just you haven't done your research. So we pride ourselves in treating founders as customers. And we're going to do our research before coming into a meeting. So when we sit down, you're more than welcome to give an introductory pitch, but we'll give you that opportunity, but we really want to get into specific questions because we're going to come prepared, and I think we just asked the same. So I think you can take that modality for the people up here or any venture capitalist that's out in the market.
And Chris, how about you in terms of founder fit? Like if someone notices something about Blumberg Capital, how do they differentiate between the various partners?
Sure. I think, online, our website, you can see my colleague Matt is deep in infrastructure and cybersecurity, and you can see I sit on quite a few boards in the fintech space. And so just by doing some homework and looking at Twitter, at our website, you can start to see where their more recent investments are. And you can use Crunchbase and PitchBook and a number of other tools as well to do that. And so you can do that for Blumberg Capital, but you could do that for every firm up here and every firm in the Valley. So I think that's kind of sector fit. There's also personality fit and other skills that you're going to want someone to bring to your board. And Fred Wilson wrote a great post on this recently about doing the heavy lifting. And so that's the type of board member and investor you want. And that's a little harder, and that's where it comes into the networking. And I think one of the best ways I tell folks to get to know who we are is talk to our founders and folks that we've invested in. And that's also a great source of deal flow for us. We have our entrepreneurs constantly sending us deals. And there's 60 plus CEOs in our portfolio versus 6 investment professionals at Blumberg Capital. So just from a probabilistic standpoint, you're better off networking there.
That's a great tip. So in terms of the fun and the colorful what not to do, the red flags entrepreneurs should not go down or should not show or should not say or should not even think about when they're thinking about fundraising. Garrett, is there anything that, yes, you never said you're too early, but you'll say don't ever do when you want to fundraise
Yeah, I
would
mean,
be.
don't ever lie. Don't ever. It's gonna come back around. Like Sara will tell me if it's not the truth. Let's see. What else things to not do, right?
Or red flags in terms of,
Yeah, we talk about execution, and so part of our due diligence process is watching founders execute, and so you have to be able to execute during that period. That's only going to translate over into your business in the long run as well. We look at this as a partnership. This is a long-term deal, especially as early as we are. It's going to be 7, 8, 10 years, and so we have to be able to be partners with. We have to be able to be partners with the founders, and so think about it that way and approach it with the long view. Don't take a short-term approach.
and Sara, how about you? Obviously, you get the note, don't lie. I got that one down.
Do not lie. I mean, I have it's hard to say unequivocally never do this. I do have some pet peeves. One is don't tell me I'm going to miss out on this opportunity. That to me is such a yawn. People actually say it I don't want you to miss out on this opportunity. Oh, aren't I so gracious for giving you the opportunity to meet with me? I actually a lot of times do feel like founders are giving it's such a position of humility to be a venture investor. But as soon as you cross that line of that salesy, don't miss this opportunity, that to me is just that's a red flag, and it totally happens. The other one is people emailing oh, I saw a colleague mentioned that you were might be interested in this space. Here's my cybersecurity SaaS company, and I'm I don't even know what that means. I'm a consumer investor, so just complete disregard for kind of thesis area. Though everybody makes exceptions, so you never know. But those are a couple things that.
Have you ever faced any opportunity though? Have you ever faced that opportunity?
Oh, for sure. So I've been at Maven for 3 years. So we haven't. I think that asked me 3 years from now, and then I'll really know what I've missed on. A lot of the stuff that I've missed on is still early stuff, right? Because they're such early investors. So 100%, I've missed stuff, and I'll know what the really big misses are in a couple of years. Yeah.
Actually, it's the fair question. So the question was, have you ever missed out on an opportunity? In terms of, don't miss it. Sara says, go away, and they say, oh, I missed that one. What's been the most surprising in terms of have you been surprised by Snap? Were you surprised by big deals? Is there some surprise that you didn't see? I mean, I know it's hard to admit that you didn't see something coming, but is there something that you in the current market space that you just didn't see? And I guess, Kathryn, I'll give it to you. I'm going to pick on the journalist, Washington Post. But is there something that you didn't see coming that is surprising, either in the macro market or either certain deals that you thought were surprising?
Yeah, I'm trying to think off the top of my head what I've seen in the last, because I've only been at General Catalyst for a year, what I've seen, and then something's kind of blown up and been shocking to me. Let's see.
Yeah, actually, Bill.
It's actually not an investment, but it's a really funny story. So my second company, my first company was here in San Francisco. Product was Rhapsody. We sold it to Real Networks, still around today, rebranded as Napster. It's back when there were record stores, if you can believe that. And after we sold the company, I was taking a few months trying to figure out what was next. And one of my friends called me. She worked for me at Rhapsody, and there's this little company called Google down in the Valley that I'm going to go work for, and I think you'd be amazing as to come in and basically lead one of the product divisions. And I was like, nah, I don't want to drive down to the Valley.
Which is valid. That's valid.
Big mistake.
How about you, Chris, in terms of anything that surprised you in terms of the market?
Well, yeah, I think a lot of the recent acquisitions in the consumer space, so Jet, Walmart, Dollar Shave Club, Unilever, you start to realize how terrible these incumbent brands are at digital, and they're overpaying massively for things that may or may not have been a good venture investment at the time, but proved to be a great venture investment after you realize how terrible these brands are at digital. And I think you're going to see more of that, not just in the consumer space, but broadly speaking. And so I think that's a big tailwind, but something that's surprising. I mean, Cruise is another great example of, now, are they overpaying or not? That's a whole another debate. But from just a pure valuation standpoint, it's massive. And I think we're going to see more of that. And I think the prices at what these assets are trading for is surprising to me.
I'd also add that I think in artificial intelligence, I mean, Cruise is a good example, but in like deep tech, the fact that there are companies spinning out of PhD programs, no business model, like technology is barely there, and they're getting acquired for $5-10 million ahead. I think that's a shocking, kind of new movement that you couldn't have predicted a few years ago, that the talent in machine learning would just be so valuable to companies.
Sara, any insight, or Garrett, in terms of things that are surprising, and either deal-wise or things or trends you're surprised to see take off as they've done?
I think that like this changing consumer behavior around, wanting it now, last mile, on demand. I mean, yeah, we've always wanted everything on demand, but there's been a lot of money poured into logistics lately, a lot focused on the last mile, a lot on demand. It's obviously based on this shifting consumer behavior, and so how quickly that's happened, how like the money just quickly moves is kind of surprising, and I think people are going to get caught. We have positions there too, and so we may be one, but people will get caught in the wrong place at the wrong time in this huge shift.
Sara, anything?
Yeah, I was actually thinking sort of a similar vein. I think it remains to be proven. We did not invest in kind of the original kind of cadre of food delivery. So they're Instacart, DoorDash, Postmates, kind of you name it, Sprig. Like, we didn't invest in that space. We do have one investment that's an autonomous technology, but it's also it's autonomous delivery technology, which I think a new kind of wave of innovation there. So I think remains to be seen, because a lot of those companies may or may not be doing super well right now. But I think as they continue to evolve, I was thinking sort of similar area that.
And which part of the stack there wins? Is it the actual robot? Is it the logistics company? Right? I mean, it's unclear right now.
And taking a step back, so just taking a little bit step back in terms of when people are throwing around, and I know you guys are very conversant in what's an angel funding and what's a seed funding and what's an A funding, and I would say that sometimes between the seed and the A, it gets a little bit blurry. And how do you guys, when you're looking at it, is there a certain dollar number? You said, okay, any pre-money valuation that's X and below is a seed, or how do you guys label seed or A? Angel, I would consider, I'm going to throw in the bucket of friends and family ramping up, but where do you draw the line? And I think I'd be curious, actually.
Yeah, I actually think it's very interesting. I was down the valley. I was telling some of the other panelists and just kind of lumping meetings as I was making my way back up. And one of the meetings, we haven't invested in the company. I was looking at their list of companies and individuals that they wanted to let into basically what was a seed round. I think angels are now coming into official seed rounds. It used to be angels were first money in, and then you'd have seed, and then you'd have Series A. And I think angels are blending. I mean, I'm seeing it all the way through Series C, probably, when I look across cap tables. I mean, it's definitely seed and Series A primarily. So I think for whatever reason, we'll see if it's a good bet for just different individuals that are becoming stock pickers. I mean, for us, I think seed, it's really about, you haven't figured out product market fit as opposed to a specific dollar. It's like, if it's an autonomous driving company right now, your pre-money may be $100 million, or if it's a hardware company. So, but I think it's, you haven't really figured out product market fit. You have a great team. And then as you're getting to Series A, you at least are having customer pilots. You're starting to get traction. So that's how we define kind of early to medium growth in that transition, if anybody else feels differently.
Well, I think let's go down the list, down the road, because I think it's an interesting conversation in terms of, for entrepreneurs, is this a seed? Is this an A? Am I going to scare anybody off because I say it's an A? Or, I mean, what do people? How do investors hear that?
Yeah.
Can I add one more comment? Sorry. I would. The one piece of recommendation that I would say is always make sure to set the bar low. So I've had entrepreneurs that wanted to come out with a Series A because they wanted to have a big splash. I think you haven't even done a financing round. So like, it's better to do a seed round. Don't come out and be labeled a Series A or a Series B. Like, start as low as you can, because when you show up to a VC and you're a Series A or you're a Series B, there are definitely expectations. So it's better to be able to over-deliver on whatever that acronym is. Sorry, didn't mean to interrupt.
Yeah.
Yeah, I think anytime somebody's coming to me raising more than $2 million, I have a hard time in that conversation, because our maximum check size, initial check size, tends to be about $500,000. And so I'm looking across the table and I'm thinking, okay, so even if I put in $500,000, I got to help you find another $1.5 million. And that's not just you, it's it's you and me now, so we got to work on this together. And that, so that's a long road to go. And I'm going to own a small chunk of the company and all these, and we're going to work really hard, and somebody else is going to come in with $1 million check then, and it's a hard dynamic at $2 million or more, I think, to be really going to a seed round. And if you're raising 4 or more, like at that point, like you need somebody that's going to like lead that, and that to me is a Series A. Anything that's kind of in the 1 to 2 range, and sometimes they get a little bit oversubscribed, and then you're a little bit above 2, and I can kind of understand that. But then the dynamics of kind of who's going to roll up their sleeves and who's going to work with you and who's going to do the heavy lifting, like who's going to be the player in the room with you. I think it's hard once you if you're trying to raise money from people that write kind of check sizes like Rewrite. I think it's hard to raise that size around.
Garrett, would you?
What's properly financing the company? I mean, there could be a case made for that first check needing to be $5 million because of some piece of crazy technology that, a rocket to access low Earth orbit. So it's about properly financing the company.
Would you guys invest in like a $5 million initial round?
No, it's just
you?
I mean,
You just wouldn't
unless
do it,
we were
right?
already an investor.
So
and
it can make sense, but it's probably not.
Totally, it wouldn't make sense for us. But if we were potentially keeping our pro rata into a later stage round, okay, that might make some sense. But for us, we tend to see the $1 million, give or take, 250 or 500. But I think once you get over 2, it starts to get into this blurry world for us at the seed.
Kathryn, how do you evaluate?
Yeah, no, I definitely agree with the comment on kind of pre-action versus like some sort of KPIs are met by the A, and it's hard to kind of speak across different sectors because in deep tech, as you're saying, like some of those seed deals are $5 to $10 million, and then the Series A will be 50 to 100, especially in synthetic biology or pharma. And so it's kind of hard to generalize, but usually seed is kind of we have a great team, a great idea, and we have a lot more to prove. And by Series A, the key metrics of the company have to be on track.
And Chris?
Agree with everything said. I'll just add one twist. Inside our shop, because we're investing in multiple geographies and a Series A deal in Europe, it looks like a seed deal in the US, we typically talk about first, second, and third institutional check. So who's leading that round? Is it an institutional investor? And if so, that would be your first institutional check. And it helps us translate kind of seed versus Series A. Obviously, check size and valuation also plays into it.
And just sticking on sort of the global part, and then I will open up to questions. I may bounce back and forth, but what region? I know you guys have an office offices in Israel, or office and
One office.
One office. I mean, outside sort of U.S. Israel, are there regions, are there countries that are active? I mean, I know our UK office is very, very active, and so too is Germany and France. But are there regions that are particularly interesting to you outside of Israel and the U.S.?
Yeah, so when we say Europe, it's mainly been Germany and the UK. We've seen other things, but haven't invested outside of those two countries. And then within those countries, it's really Hamburg, Berlin, Munich, and then London in the UK. So it's even more concentrated from a city perspective, but that's where we spend most of our time. And typically, we're not going there looking to lead deals, but it's more opportunistic where there's been an early investor, whether it's a seed or Series A investor, and the company wants to expand its footprint outside of Europe, where we'll come in and typically lead what is called a Series A European deal, but typically looks like a seed deal.
And how many of the other panelists are focused on or are particularly excited about certain regions outside the U.S.?
I'm very excited about international investing, and part of that is macro. I think right now it is very difficult to hire 10 engineers in San Francisco without a lot of capital, and there are so many pockets. We just invested in a company where most of the engineers are in Ukraine. There's so many pockets of exceptional talent in Europe and across the world where we tend to invest in companies where one of the founders is in the US, so that either sales and marketing is here, but the engineering is elsewhere. I just don't think that over the next 5 years, if real estate stays the way that it is and just the prices of engineers, that it's feasible to create a massive company unless you're lucky and able to raise that kind of capital early on.
And Bill, you said?
So the last deal we did was a Series B out of London, and we recently, Carl, I think you're around here somewhere, Carl. Yeah, there we go. He flew in from Sweden all the way just to see the Orrick event. Carl joined us from Insight Partners, so for us, I'll put words in his mouth, right? It's London, Stockholm, Berlin, Tel Aviv. But yeah, we invest about 20% of everything we do in those regions. Just amazing technical talent, as everyone said, and I think a little bit of a less efficient capital market, so you got to take that into consideration. But just amazing founders, their liquidity pathways, whether it's M&A or IPO there. So we're big fans, big believers.
And it's not only happening international. I mean, if I look at our last deals, Montreal, Vancouver, Salt Lake City, Austin, Texas. And so it's an extension of kind of the domestic footprint as well, to your point on just the cost of doing business in the Bay Area.
I mean, Salt Lake City in particular has been really interesting to see the rise. I mean, Southwest has always had some of its back office there, but really interesting technical, lower price. So, and how about Maven and B in terms of international?
I'm actually from Idaho, so I've been scouting the Intermountain West for a while. I think there's really good attributes to it, but we're seeing Toronto emerge actually as a market as well. Strong technology, technical founders coming out of Waterloo, good subsidies from the Canadian government. So we have a position there. I'm going to go visit them shortly, and I think Toronto could be great. Toronto, Vancouver.
Something about those Waterloo engineers, I'll tell you what.
That's right. They're everywhere.
The secret's out now.
I know, right?
Now everybody, that's for sure. We do primarily, most of our investments are in the Bay Area. We have a handful that are in other places in the U.S. And in the rare exception where we have anything international, I mean, we're a 3-person team. Like, I don't even know how to get my arms around, like, the start a investing scene in Germany. Like, I don't even know where to start. So most of our stuff is here. Though we do have a couple of instances that are the teams are primarily here, the CEOs here, the customers are here, they're U.S. consumers and other customers. But the founder CEO has some sort of connection, not like an outsourced dev team, but like we have one founder CEO. She's from Israel, so her team is in Tel Aviv, her CTO is there, her founding team. So there's a team there, and it's like a full structure, but she's based here, the company is kind of based here. So we do have some situations like that, but the CEO is in the US.
Nice. All right, I will open up to questions. Manager.
So a lot of first money in these days seems to be in the form of safe agreements or conversion notes. Do you guys do any of those?
So the question, just so everyone heard it, is safes and convertible notes are typically or have been in the last sort of 5-7 years first money in. So the question is, how do you guys evaluate the two? Versus, I guess, more of a Series seed priced equity.
Yeah. Yes. I mean, typically like to see caps, right? I think for a variety of reasons, just uncapped notes in general just don't favor either side, but we're open to it.
Yeah, we do a lot of safes and convertible notes, and also priced rounds. So we have kind of less religion on that, though I will caution that it's really easy once you're in the habit of stacking up those notes, easy to keep going. So you got a $5 million, you got an $8 million, you got a $12 million, you got a $20 million, and all of a sudden you've raised $5-6 million bucks, and a Series A investor comes along, they want to give you a good chunk of money, and then they realize their post-money valuation is inflated by, once all those caps are taken in, $8 million, $10 million, like that's tough. So you want to exercise, I think, some caution with it, because I've seen it happen, and that's challenging. But yeah, we probably more frequently than not do kind of safe or convertible. The structure? I mean, it depends. Usually it's more of kind of round dynamics. Like, do you have two 500K checks that are coming together for $1 million round? If that's the case, you're probably going to do a price seed round. Do you have like a bunch of angels that are coming in and multiple people you're going to have to close, and it's going to be just kind of a messy rolling close process? In that instance, kind of batch everybody together. Do you want 6 months to do it? So it kind of just depends more on the round dynamics, I would say.
In between the other 3 panelists, and do you have religion between price? Because some VCs are very strong that they don't want to deal with convertible notes. They'd rather have a priced round.
No safes, no uncapped notes, and I think what Sara said is super overlooked. I think a lot of founders try to close, and it's great, but you end up in these weird scenarios, and it messes you up downstream. So.
We're more agnostic, although what we typically do if we are doing a convertible note is structure a board and take a board seat, because we're typically leading deals, and also make sure there's pro rata rights for major investors. So with some caveats, we're agnostic.
That's interesting. So you take board seats with any sort of size convertible notes, or is it sort of a...
No, when we're leading, because our strategy is typically to lead deals, so 80 or 90% of the time we're taking a majority share of the round, if not more. And in that instance, when we do use a convertible note, we'll put a board structure in place. If we're putting 500K into a YC round, it's totally different.
Interesting. All right, lady in front.
My question is focused on a company that is seed stage, has a product ready to launch, but is still pre-traction, and needing your advice on establishing pre-market fit, user testing. What specific advice do you bring to startups at this stage in mapping out an efficient path forward to establishing that product market fit? And what tools are currently new out there? For example, 4 to 5 years ago, it was about growth hacking. How have we evolved since then? So everybody in the back here.
Might want to repeat that.
So in terms of pre-product, pre-launch, what guidance do the panelists sort of provide to those companies, and what tools are out there for companies like that? Is that good and sufficient? Anything else? Okay.
Yeah, I just start here and then we can go down the line. I mean, I think it all depends on the type of business is the first thing. I mean, a few case studies. We did the seed round in a fintech company called Tally that, even before launching the product, they did a Series A, just an amazing team. So for them, it's a consumer-facing product. They're all about trying to automate personal finance. They're starting with a credit card. So a lot of the initial go-to-market was you had to do strategy testing around organic and paid, and I mean, as well as just general product market testing. So then versus an enterprise, which you can get a very select few of customers and try to figure out, are you going to SMBs or large enterprises? I think the general trend, if I were to just try to bubble it up at a macro level, is just get in front of customers and as many customers as you have. This one company I met today, they were the original founders of OpenGov, which we were an early investor in, and Zach, who's the founder there, has been getting a lot of press. He was sitting side by side with Jeff at Amazon. I was like, maybe let's deflate your ego a little bit, but they're in the GovTech space, and they took basically a PowerPoint, and they started selling the PowerPoint to state and local governments, and are starting to get pilots. So doing that customer interaction early, whatever your business, consumer, enterprise, I think is at least a good start.
And just on that, and I have seen from working with clients the mantra from the VCs and the focus of customer acquisition costs, customers, and maybe it's always been there, but in the last sort of a number of maybe 6 to 12 months, that has been a prime focus of a lot of meetings in terms of the feedback that I've gotten through entrepreneurs.
Well, I think there's this interesting fallacy. I was just talking to my associate today about it. With customer acquisition cost isn't always what it seems. It actually kind of increases sometimes over the life of a company. So it's this like fallacy where, well, you think, oh, we're getting scale, and therefore the customer acquisition cost is going to drop. It actually doesn't, because the people that take your product at the beginning are the ones that would have taken it anyway. And so it actually becomes more expensive to acquire these customers that are, experimenting or not target or in a different geography. And so there's this weird fallacy there that tricks us all the time.
Interesting. Chris, anything before
I was going to say, it's important to differentiate, I think, to the point on it depends on the sector. For instance, enterprise, we have a CIO council, which are Fortune 500 CIOs. We basically put companies in front of them and say, if the company builds this, will you buy it? And so it's a way to test pre-product, because we do a lot of pre-market, pre-revenue, pre-product investing, to test the hypothesis of the entrepreneurs and help us diligence that. That's almost impossible to do in the consumer space without doing, a lot of focus groups and spending capital. But we can do it very quickly on the enterprise side. So it also depends what kind of company you're building.
I mean, on the consumer offer, what we look for actually tends to be less around the actual customer acquisition cost and more around kind of like a series of questions. How are people doing this today? Why is your solution better? And how are you going to get them to find out about it and switch to using it? So that's kind of the question arc that we look for. And with consumer, especially with consumer mobile, I think fintech's different because if people have to like spin up a whole credit card company, I mean, that takes a lot of there's regulation, there's all this other stuff. But kind of traditional consumer companies, just see if the dogs eat the dog food. Like the last one that we invested in, that was like a true consumer kind of high growth consumer mobile play, which we don't do that frequently, but we still do a decent amount of, was like 2 people that started a company, and they were number 5 in the social networking category on the App Store, which is a very competitive category. They were behind Facebook Messenger. So like that to me, like they started it, they hadn't raised any money, they just went and they just did it and it worked. So we're able to see some of that, Yeah.
All right, I'm going to go for the back and move things around.
I have a question on syndicates. I had a VC say, I'll write you a check for $750K if you bring another VC, who will write you a check for What's sort of the thinking behind that?
Low conviction. I mean, if I'm going to write a check for $750,000, like I should have conviction in the company enough to not only write that check, but to help you go find the other 750. So I don't love that.
And do you when you're looking, do you have people in VC funds that you consistently, like Kathryn, are you consistently partnering, not maybe partner is the wrong word, but much like, it sounds like Maven and B are sort of together many times.
By the way, we only invest in one company because he does all enterprise, I do all consumer.
Like,
It was a good
So
choice.
so everything I see in enterprise, I'm like, you gotta talk to my buddy Garrett.
Yeah, we go
He's
back
in
and forth.
consumer, he's like, go talk to Sara.
Then you get the marketplace. Or
We have
whatever.
one shared co-investment, so we don't invest that much together.
Is that neighborly?
It is,
Isn't that very nice? Well, nice choice.
Yeah.
But Kathryn, do you also sort of find certain VC funds that you play well with and that you throw deals to?
Absolutely. I think at Series A and above, larger funds, like we rely heavily on micro VCs to tell us what they think is interesting, to talk about theses with us. And I would say it's not like a formal partnership or that there's people that we look to syndicate with all the time. But there are funds where you can tell that we have very similar missions and that we're interested in the same sorts of companies. And if we're working on theses together, we're working a lot on the future of cities. Like that makes for perfect partnerships in a lot of ways. So I definitely think that without micro VCs, it would be, it's incredibly important to have those relationships.
And maybe one of the other aspects of your question is when you're leading the round, or you may be at this $800,000 of a 1.2 round, how much do you feel like it's your responsibility to raise, and how much do you push on the company to say, come, go drum up some interest? Bill?
I mean, I'll tackle that. I think it's a partnership, right? I mean, I think a lot of the other panelists were hinting at this, but I think venture capital in the last 15 years has come a long way. It used to be, hey, like we're writing checks and that's all that we're doing, and we're sitting back and we'll show up to board meetings and pontificate. And I think there's been this big momental shift that venture capitalists are really coming from operating backgrounds, really rolling up their sleeves. So I think it's always a balance. I don't think you'd want a founder that's like, well, I'm just not fundraising, right? And I don't think you should have a venture capitalist that's like, well, I'm not going to help you. So I think it should just be equally balanced.
Well, I think because the stuff that we do is so early, and I don't have like a team of we have one associate who does a lot of stuff, all of our marketing, all of our ops, like everything for us. So we don't have a team of people doing diligence. So I actually really lean on other potential co-investors for diligence as well. Like what I would say in that instance that might be a little bit different is like, we're really interested in then here's the 5 people that I think might be interested to co-invest with us. Why don't you go talk to them and let's see what they think. Let's see what I think. Like that's helpful for us as part of the diligence process as well. So because most people raise more than $500,000, like there need to be multiple people in a round, and so it's to our benefit to kind of help bring that together. And if those 5 people all say like, nope, saw 10 companies like it, or like, oh, I totally don't get it, or I worked with that CEO and didn't think they had a, didn't think that they're, didn't have a good experience, or whatever it might be, like that's helpful diligence. If they're all like, we're going to fight you to get in this round, I'm like, I'm going to write my checkers. I think it just depends.
Nice. Lady right there.
Hi, my name is Mary Palmieri. I'm in the consumer product space, and my question is, we're preparing for a seed round, and I want to know what the typical timeline is like from meeting you to closing on that round, and what's to expect there.
So the question is, and we're going to stick with sort of seed rounds, timing from, I'm going to even go back to, how long can it take to meet somebody, even on this panel, and how much does it take in terms of the courtship, and then the meeting with your partnership, and then what's the timeline in getting it done? Of course, when we hear in the lawyers, it's like we want it done yesterday. So I'd love it from the investor perspective. Yeah, exactly. The answer is yes. So what is the timing? What are the expectations from? And I'd say, put realistically, I mean, do you have the Monday meetings that must happen? So if you meet the investor on a Tuesday, you know that it's going to be at least a Monday next that they can even have an indication. So I guess open the floor time-wise. And Chris, I'll go down there.
Sure, yeah. Well, if you're raising now, it's the summer, so it's good luck getting all partners around a table on a Monday meeting. But ours is pretty streamlined. I'll just speak for Blumberg Capital. Assuming you have a first meeting with one of the investment professionals, they typically bring that to the group in a Monday meeting, discuss, usually fairly quickly. Then a full team meeting is scheduled if we want to move forward. And we actually have open slots on Monday and Wednesdays. because there are times where we'll see a company on Tuesday and we don't want to wait 7 days to get the company in front of the partnership. So we have a few time slots reserved. And then from there, typically we can get to an indication of interest. So we can get from first meeting to term sheet in a matter of weeks, anywhere from 1 to 3 weeks traditionally. And then in parallel, once the term sheet's signed, we're doing diligence, and we're either going to long form docs or convertible note docs, which are super simple. So to get cash in the bank after a signed term sheet, you're looking anywhere from like 3 to 6 weeks. Now, that's super streamlined thing. If VCs know they have time, they'll probably take more time. And so pressure and momentum is always your friend.
Kathryn, would you say, and on this Monday meeting, and I don't mean to, to get too confidential, but does everybody present it, or is it possible that you meet an exciting company on Thursday and you don't get called on? I mean, I've never sat in on a Monday meeting. All I know is that they have the religious aspect of the Monday meeting. So I don't know what, tell us what the Monday meeting sort of means to.
So I think for us, one of the most notable things about General Catalyst is we're a very collaborative fund. So many of our founders will be working on an enterprise deal that only one person understands because it's so deep in the stack, but they will have met with every partner individually and gone through their pitch. So for better or worse, that might take longer, but it's a much more collaborative approach to investing. And we do have companies that we invest in present at the Monday morning meetings, and we try to be quick. I mean, it's one of these things where if we know that you're in a space that we're not investing in, we're not going to wait a week to tell you after the Monday meeting and say that we brought it up and did an extensive review. I think in a lot of cases, and we try to give 48 to 72 hours kind of an approach of what are we thinking about this, because your time is just as valuable as ours, and keeping someone on the line for a week and a half, depending on what's happening with Monday morning meetings, is not the founder-friendly approach.
Yeah, I just chime in. I agree with everything everyone said. I think a few things. One of my good friends, Brian, who's at Founders Fund, gave me some really valuable advice. He said, the best thing you can ever do is pass in the meeting, right? And it kind of gets to your point of it's very hard to do, but if you just know for whatever reason it's not an immediate fit, like be able to do that. I think the timeline you put out earlier is, I 100% agree with that. I also think, going back to our networking comment, getting to know VCs at a partner level prior to raising and starting to engage with them is like the best advice I can give anyone. And just be honest with them. Hey, we're going to be raising at some point. I want to get your input on consumer or on enterprise or on fintech or whatever it may be. Because I think if you can start to build that relationship, the last thing a VC wants to hear is, I'm taking meetings over the next 2 weeks, I'm expecting term sheets. I mean, for us, we're kind of like, okay, great, thank you. It's not the deal we want to do. So do it as soon as you can.
And does Maven do, Monday meetings, or because you said you're three people?
Yeah, I think our dynamic is different. The quickest we've gone from first meeting to check is 9 days. That was really fast. Wow. And as I mentioned, some founders we've known for 2 years. So it kind of, the staging matters. Our Monday meetings, we don't bring founders into. We do like a Monday catch up, but it's usually a review of all of the opportunities that we've looked at that week and sort of discussion internally. What are we excited about? What do we want to move forward with? I want to get back to people kind of a week between each step of the process is what we look for. So between when you meet me and when you hear back, I want that to happen within a week. If you do a second meeting with my partner, or you've met with him and now you're meeting with me, if you do a second meeting, we want to let you know within a week from that meeting if we're going to go into diligence, and then we want to get the diligence done in a week to two after that. That's kind of the ideal setup, and it's sort of what we strive for. I want to be better at passing in the meetings. I have such a bad hit rate because people debate me about why and so I just stopped. So I just don't do it because I'm like, if I know it's not a fit for our fund, your time is better spent. I just don't have the conviction for it. Your time is better spent convincing somebody else. So I'll pass over email later and I'll tell you why. But if you know how to pass in the meeting, I'm going to tell you later. I'm going to talk to you later and you're going to tell me how to do that. It's really hard to do. So I try to do it within a week. Sometimes it takes longer. Ideally it's 2 days, but sometimes it takes more.
Garrett, do you have a sense of timing? Even though you've never said that you're too early and
Those are unrelated, maybe. Let's see. Mark Suster has a famous post called Invest in Lines, Not Dots. And so through the due diligence process and through this relationship we're building, you're putting those dots, right? There's a little bit of a breadcrumb trail that's to be left for us to chase and follow. I think the week cadence is good. We're partnership at 2, as are you, and so it's hard. I mean, I was grinding Michael last night. He was in Europe, and it was 10 p.m. And I was like, we have to do this meeting because we have founders we got to get back to. We're going to be disrespectful of their time, and so that cadence is real.
Excellent. All right. I'm going to turn off.
This for seed stage, do we expect the founders?
I'm just going to turn off this. No, I'm just turning off this water.
Do we expect the founders to come in with a valuation in mind and/or terms if it's a convertible note? What's the expectation there, or is there a standard for equity and seed usually in this range?
So the question is, and it's a really good one, how much, and I'm going to tweak a little bit, but how much should an entrepreneur lead with the term sheet and say, here are the terms, here's either the valuation, here are the terms, and what do you think? Or how much do they sort of wait for you to say what the terms are going to be?
We'd like to know why you're raising money and how much you're raising. So, look, I need $1 million to do this, this, and this, so I can, answer these questions and put this product to market. Maybe it's product market fit. So, the conversation is more about how much you want to raise and what you're going to accomplish with that.
And if you have people committed on certain terms, and it's like a decent amount of your round, you should tell me what that is, and yeah, that's important, right? But if you're like, oh, I'm raising at an 8 million valuation cap, I'm like, from who? You're like, oh, nobody's committed yet. I'm like, all right, well then you're raising at whatever people want to give you money at. It's like a different, so nothing false. Again, I think it goes back to that earlier point, but.
Kathryn, any?
No, I completely agree with that. The most important thing is to know why you're raising a certain amount of money and to have a very good reason for it.
Yeah.
Yeah, no, I was going to say the exact same thing. I think you put it eloquently. It's all about just basically your use of proceeds, how you're going to use that. And then I think, look, the reality is it's a dialogue. I mean, it's not like you're going to go into a meeting and then someone's just going to email you a term sheet and that's going to be it. I mean, I think the whole VC founder relationship starts very early on, kind of that idea of breadcrumbs, and extends all the way through the term sheet. So I think it's something that you discuss. Okay, you think you need 2 million or you think you need 25 million. Well, maybe you need only $1 million, and then let's prove that out, and then here's why we're thinking about that. And I think it goes back to that debate. And then if you have the right partner, both in the founder and the VC, that's kind of where you can come together.
We'll do a couple more. So,
okay.
Yes.
I think the dynamics of the investors is really important for the companies that you're funding as well. And if you could go into what was a real great experience that you've had, and what role did you play in the dynamics of that first round for a company, that would be really great.
And you're talking about between the investors. So the question goes to how the dynamics play out between the investors, and what sort of role do, I'm going to say, lead investors play in either shaping that dynamic or encouraging the good things, or narrowing the negative things that are happening. So maybe Chris.
Just one example from each of
Okay.
them of what was really key for them.
So key dynamic shaping.
Sure. I think there's a bunch that goes into it, everything from building out the syndicate to building the board. I mean, a good case study in one of our early stage seed investments, we brought a very high profile executive in as a chairman, and that was a relationship we had, and we put an independent board seat for the company, rather than us take the board seat, made that an independent seat and brought somebody from the outside in, because we thought that was the best thing for the company and would help them and us capture more value. So it's everything from, again, syndicate, board seats, helping think about customers, so leveraging the network inside the venture firm early on to bring customers to bear. It's all of that.
Excellent. Kathryn, in terms of shaping the role and the sort of interplay between the investors?
Yeah, I mean, I think a good example was a company we invested in a couple months ago, where the partner that was working on the deal had worked before with the other investor who initially led the deal for another fund. And I think if you've worked together in the past and it's fruitful, that's the best indication, and that always can't be the case. But having some sort of history with the people that you've worked with and seeing how they operate around the table can help build a complementary syndicate.
And Garrett?
I'm going to go with a weird example where a deal was introduced to us through a corporate venture capital company, and they really encouraged this founder. It was about this individual to go out and build this computer vision technology solution. And they said, we really want you to lead it because you're pre-seed. So We did our own homework, and it wasn't based on their do or don't invest. We ended up leading the round and creating a space for them if they wanted it. Fast forward, I don't know, 6 months maybe, because it's corporate venture, and they ended up passing on the deal because it was too early. And I was like, okay. And so back to the drawing board, but at the same time, here we've closed, and there's a couple other people in the round with us, and so now we're back to syndicating again. And so you have to dive all in and tell the story and be transparent about it. That's what we did.
Corporate venture.
Corporate venture, that's what you get, and it was a good fit, and it still might be, but...
Did corporate venture capitalists ever come in the first close?
No, and that's what was surprising, right? And it's like, yeah, fool me once, right?
Sarah?
Yeah, I will say we've actually done maybe the last two deals we did were introductions from investors who passed on the round, but they were like, you actually might be interested in this, and then we did those deals. So that definitely happens, which is great. I would say a dynamic that worked really well for us was a company we'd known this founder for about a year and a half. We initially said it's not right for these reasons, and then my partner kind of got wind that they were thinking about raising an extension, and that they'd pivoted, that they'd addressed a lot of those concerns, and then we thought, oh, that's interesting. So we reached back out and had another meeting with them. Ended up coming in to them with that, and then even in the process of that, it was a positive interaction. I mean, we like to get pro rata rights. That's often like sometimes it's a we'll walk if we don't type of term, but it depends on the round. So we like pro rata rights, we like major investor rights, but we don't take a board seat. And so if we're able to figure out with a founder of like how to come together on those terms, like we want the pro rata for these reasons, we want the major investor rights for these reasons, but we're not going to take a board seat, but we want to be invited to the board meetings. And so being in a situation where you feel like you can have that dialogue and come to terms that make sense because you want those partners on both sides, that was a pretty positive experience investing in that round.
So does that mean you don't lead them, essentially, if you're not taking board seats?
I don't think board seats really matter I think if somebody's taking a board seat, that person is leading. If there's no board seat, it doesn't necessarily mean that there's not a lead. We often lead. We just don't take those because the staging. We just don't formally set up. We don't formally have board meetings. We don't formally do that. We do have a lot of advisory board meetings. So we set up a structure with all of our companies to meet with them on a regular basis. But we just don't take legal board seats. We do take a lot of board observer rights, and so we're kind of continue to remain engaged. It's just not our model. So in many instances, there's not an investor in the round that's taking a legal board seat.
And I guess, Bill, in terms of just back to the investor dynamics, how many times are you on the phone between investors, and how many times are you sort of on the phone with founders? Is there
a lot.
Both a lot?
Yeah. No, I think your question is around the investor dynamic and what's a case study. I go back to that Tally example because it was a seed round. Two-founder team, they were backed exclusively by Kleiner and their previous company, and they basically had a business plan, and it became oversubscribed. We got into the round, it was us and Cowboy Ventures and a few execs from Google, and it was just a good dynamic with Cowboy that brings a lot of brand voice, a lot of messaging component. We're really heavy. We have two partners that all they do is marketing. One's a design partner, one's basically a digital marketing partner, so we were able to help early on. We brought the Series A lead, which was Shasta, and Shasta's kind of what they brought to the table was that go-to-market, right, and then at scale. And then tomorrow, we're bringing what could be an independent board member that comes from a very well-known firm in the fintech space. So I think it's an interesting dynamic where investors are an extension of your team. And in that case study, it's us and it's Cowboy, and we have some Google execs, and then we brought in Shasta, and now we have an independent board member. So you're really building the board and the investor syndicate just like you would as an executive or a founder.
So I'm going to do sort of one final question, and then I'll ask sort of some closing thoughts, and then I will let everybody descend on people. But I know that at some point, everyone here may say uncle and have to leave, but that's what normally happens. So just get ready for it, guys. All right, lady in the pink.
In addition to money, how do you like to ideally work with your entrepreneurs?
So the question is, in addition to money, how do you work with your entrepreneur investments?
We talk about mitigating risk and time risk as well. So either creating time for the founder, a little bit of blocking and tackling for them, saying, okay, I sure you want to spend your time on that. So we turn from a cheerleader to a risk mitigator, I think.
This is like such a hard question. I feel like you have to go ask the founders, because I think there's stuff that I think I'm doing that's helpful for them, and I'll find out later that the thing that was most helpful for them was something that I thought wasn't that big of a deal. I actually just had an interaction with a founder over email where I thought I'd sort of misstepped in a meeting and was like writing them to be like, hey, I'm sorry, I feel like this thing didn't go so well. And the founder was like, no, you're super helpful. So I think you have to kind of get a sense from founders in the portfolio. More tactically, we do like to set up like monthly advisory board meetings if we can, not to have a formal board meeting, but to walk through what's a pretty standard agenda of kind of like, what are the key issues? Where is the company right now? What are the key issues that we're facing? What are key hires? What's our PR and marketing plan? What's our cash position and fundraising needs? And how can I help? So we do try to have some kind of structure around that sort of like monthly cadence, and then from there, it really is just trying to be on call all the time by text, phone, email, like having stuff set in person. It's a pretty wide range of stuff. But I mean, we're early, so a lot of stuff around fundraising, a ton of stuff around strategy, consumer growth, big area of expertise for us. So, kind of pitch in wherever, but we do become kind of an extension of that founding team.
Yeah.
But ask my founders, tell me what they say.
Yeah. We've tried to systematize it as much as we can. I mean, I think a big component is building off what you were saying is it's just about getting alignment where the company wants to go. So in our Monday meetings, right, we tried to make ours different. A big focus is on value add. So we've got scorecards that basically are by company. What's the company trying to achieve this year and this quarter? And then what are we actually signing up to do? And I think what we learned was we wanted to solve everything early on, but you can't do that. So for us, it's all about capital, revenue, and then corporate development. And those are the three things that we do. Yes, we'll help with talent, but we really try to laser focus on what we can do and make it scalable and repeatable, as opposed to trying to be a consulting firm and solve everything for the company. So I think it's identifying where the company needs help and then kind of that overlay on where we can add value and not trying to do everything for every company.
Chris?
Yeah, it's a tough question because every company needs something different along its life cycle and depending on what sector it's in. Sometimes the CEOs just want to call and have a therapy session with a board member. Sometimes they need recruiting help. Sometimes they need partnerships. I need to meet executive XYZ at this company because we're working on an interesting opportunity. Or should we go out and raise our Series A now, or should we wait on the other side of this contract we have coming? So it's so varied, and you're just in the trenches on a day-to-day basis, and we'd like to think of it just as an outsourced extension of the team and activating our network any way we can for the entrepreneurs.
We have a Thursday meeting. So on Mondays, you have like the classic meeting of what are we going to invest in. But on Thursdays, it's actually our portfolio meeting. And the entire team gets together and talks about the needs of their companies. And it goes back to what you said about kind of scaling the resources, that it's not just one board member with one entrepreneur, but someone who might have only met the entrepreneur a couple of times and doesn't know much about the space might have that perfect hire or might know what the problem is with pricing. And so by scaling the resources of the entire team once a week, it actually solves a lot of the problems that you would see come up between that kind of just bandwidth problem that you get with an investor that might not have, might have 20 boards or something.
Cool.
Garrett, anything to add on?
We actually hired a portfolio ops person, 8-time founder, guy's 58 years old. He's like super cool surfer guy, but he has been there and has sat in the shoes of all the founders. And all he wants to do is help portfolio companies. And so maybe we found this unicorn guy, but he joined us to specifically support and try to productize some of the offerings. So a lot of firms are starting to do that now.
And I would say that when working with entrepreneurs, what we try to really remind them is that venture capitalists or whether they're angels or seed investors or series, there is so much. This is a beginning of a relationship with these people either on this panel in terms of the things that they can bring to your company when the relationship works well. So the money is the great first thing, but it's day one. It's that back and forth that really matters to how these companies grow. So I do want to let you guys have one final sort of big picture, and Kathryn, I'm going to start with you, just because we were talking about it. But over the question of sort of fundraising landscape, like where are the opportunities? Like where do you see the opportunities? I'm going to ask each of you the same question, and you can take it wherever you'd like. But where do you see the opportunities?
So one of the areas of focus that I think has just been a missed opportunity for a while and not as much anymore is this middle American consumer and consumer landscape, I think it's really easy to start building, or I shouldn't say easy, it's never easy to build a company, but a lot of people always start at the top saying, I want to go after those Henrys, that the high income person living in San Francisco that has disposable income for my consumer company. And when you actually look at Fortune 500 companies, or if you look at the Fortune 100, most of those are commodity companies. Most of those companies are targeting people in middle America. And so how you build a company starting at the top and moving to that segment is actually really difficult, and I encourage people to start kind of at the middle with that person in mind, that mother in Kansas that has a tremendous amount of spending power, but technology has not been kind of shown to her in the same way that it has to people living on the coast. So that's what I'm looking for in terms of companies that I think have a lot of
Excellent. Bill, where are you seeing the opportunities?
I'm going to give you two because I can't give you one. I think voice in the enterprise is fascinating right now, and could go on for hours about that, but keep that really simple. And then I think logistics, some of the panelists touched on this earlier. There was this big wave in commerce, and I think we're just now catching up with the technology and the logistics through the entire life cycle to be able to support that. I think there's going to be a lot of opportunities over the next 10 years there.
Garrett?
Stodgy industries that are overlooked, like logistics, chemical marketplace, insurance. I think that there's always disruption happening, and so just timing it in these old industries are commodities, and so let's bring some new solutions.
Excellent. Chris?
Ditto what everyone said. I think there's a ton of opportunities, and I would say, I guess, two things. One, don't start a company just because it sounds fun and interesting. We see a lot of people perhaps starting companies for the wrong reasons. I think, again, going back to that authenticity comment, because it actually is really hard, and in order to have success, you're going to want to be doing it for the right reasons. That said, I think one massive opportunity, just the intersection of kind of fintech and healthcare. There is a massive problem around billing and payments across the healthcare infrastructure. It's probably one of the hardest problems to solve, but if someone can figure it out and dive in the minutia and build the technology, there's probably $1 trillion company to be built there.
That's big. Sara?
Yeah, it's a good segue because healthcare is a big area of interest, and really on the consumer side, I think consumers are understanding, interacting with, paying for their healthcare in a way we've never seen before in this country. So I think that, I don't know what the businesses will be yet, but that will definitely make way for massive consumer brands in the healthcare realm. So that's a big area of interest. The second is, I think we're in the middle of a tidal wave of massive financial independence of women. Women are buying homes at 2.5x the rate of single men. For the first time just a few years ago, the number of single women surpassed the number of married women in the country. And so the amount of financial independence that's available to women now, again, our country's never seen before. So what are the software products that are going to kind of come because of that movement? And then, as Maven always has, we're very interested in kind of those new novel other consumer software ideas, things that can get in the hands of tens of millions of people that just don't exist out there yet. And it's such a saturated market now that those things have to hit a higher bar. But kind of what are those new those new consumer software companies? It's an area we'll continue to invest in.
Well, the great news for people in the audience is they've all described a myriad of different industries that you could go into. So that we didn't, there were some threads, but there's a lot of opportunity there. Thank you guys so much for participating. Thank you guys for sticking around. I appreciate it.